Delta is flying 30-year-old Boeing 767s on its most premium routes. Meanwhile, United is clinging to 30-year-old 777s that it literally cannot find engines for. And American? They permanently retired 48 wide-body jets in 2020, the exact hardware they desperately needed to cash in on the post-pandemic travel boom. 3 airlines, 3 completely different bets, and wildly different results. Look at the scoreboard from 2025. Delta printed a staggering $5 billion in net profit. United brought in a healthy $3.3 billion. And American? They scraped together just $111 million on over $54.6 billion in revenue. That is a profit margin of 0.2%. So, how does the airline with the oldest fleet generate the highest margins in the sky? How does the carrier with the biggest order book keep running out of airplanes? And how did the airline with the youngest fleet end up making almost no money at all? It turns out the answer isn't about which planes they bought, it's about when they bought them, what they paid, and what they did to the cabin once the metal showed up. Right now, 3 fundamentally different fleet strategies are playing out in real time. On paper, all 3 approaches have logic behind them. In practice, 2 are printing money and 1 is scrambling to undo years of decisions that looked smart on a spreadsheet but gutted its ability to compete where it matters most. This is the story of how the same industry, the same economy, and the same passenger demand produced 3 completely different outcomes, all because of how each airline answered one deceptively simple question: what planes should we buy? To understand Delta's approach, you have to go back to a pattern that started well before the pandemic. In 2012, Delta did something most legacy carriers would never consider. They bought at least 88 old Boeing 717s that Southwest was shedding after its acquisition of AirTran Airways. These were planes that didn't fit Southwest's all-737 fleet. Delta grabbed them at bargain rates and deployed them on short-haul domestic routes where it didn't need the latest cabin product. It just needed cheap, reliable seat miles. That same logic drove another deal. When Bombardier was struggling to sell its brand new C-Series jet, which would eventually become the Airbus A220, Delta swooped in with a massive order at a time when Bombardier desperately needed validation. Reports at the time suggested Delta negotiated a price well below list, somewhere in the range of $33 million per aircraft. This is the playbook. Delta doesn't chase the newest, shiniest thing. It times its moves perfectly. Sure, it has a fleet that's older on average, but it still is remarkably capital efficient. While other airlines were hemorrhaging cash on brand new wide-bodies, Delta was squeezing every last dollar out of its Boeing 767s. Those 767s, some dating back to the 1990s, still make up the majority of Delta's domestic wide-body flying. They fly premium routes where passengers pay top dollar, and Delta is serving them with 30-year-old airframes that have been refurbished with lie-flat seats and premium cabins. It works because Delta invested where it matters most to the passenger, the cabin interior, and saved where it mattered most to the balance sheet, the acquisition cost. But even Delta knows you can't fly 767s forever. In early 2026, Delta dropped what might be the biggest fleet announcement in a decade, an order for 30 Boeing 787-10 Dreamliners with options for 30 more deliveries starting in 2031. This was a shock. Delta had been ordering Airbus widebodies exclusively for years, with its next-generation widebody fleet consisting of A330s and A350s. Having all your new widebody orders in the Airbus basket, it's a risk. The 787 order also addresses a real operational gap. Delta's 767s are aging out. By securing 787-10s, Delta locks in a fuel-efficient replacement that offers 20 to 25% better fuel burn than the aircraft it's retiring, while also diversifying its supply chain. Now shift to United, which has taken the exact opposite approach. In June 2021, United announced United Next, the largest aircraft order in the airline's history. 270 jets, including 200 of 3 different Boeing 737 MAX variants and 70 Airbus A321neos. The vision was bold. Upgauge every hub, add premium seats at a pace that would grow premium capacity. On paper, it was brilliant. United would have the largest fleet, the most international reach, and the most premium revenue potential of any US airline. In practice, Boeing happened. The 737 MAX 10, which United was counting on as a cornerstone of its narrow-body strategy, has been stuck in certification limbo. United was expecting deliveries in 2024. None came. It should come in 2027. To patch the gap, United leased 35 Airbus A321neos for quick delivery. This is the move you make when your original plan breaks. Where United has genuinely excelled is in the cabin product war. United invested $150 million in what it calls Polaris Studios on its 787-9 aircraft, featuring privacy suites, elevated interiors, and Starlink Wi-Fi. These deliveries were scheduled to begin in late 2025 for international deployment in 2026. They were delayed, but United's international network remains unmatched in raw scale. More transatlantic flights to Europe and Africa than any US competitor. More wide-body seats than any competitor. United is building major infrastructure to support its future growth, including a $177 million ground equipment maintenance facility and a $16 million tech ops training center at Houston Intercontinental, preparing for fleet expansion through 2032. The ambition is real. The question is whether the manufacturer can keep up with it. And then there's American Airlines, which brings us to the most puzzling fleet strategy of the three. During the pandemic, American made an aggressive move to simplify its fleet. It retired its Boeing 757s, 767s, Airbus A330-200s, and A330-300s. In total, roughly 50 wide-body aircraft were permanently removed. At the time, it looked like smart cost-cutting. Fewer aircraft types means lower training costs, fewer spare parts, and simpler maintenance. But the post-pandemic boom exposed the flaw. American's wide-body seat counts shrank down from higher levels just a few years earlier. On the most lucrative long-haul routes, the ones where premium passengers pay thousands of dollars per ticket, American simply doesn't have the hardware to compete. American's challenges go deeper than the wide-body shortage. Several years ago, American launched Project Oasis, a fleet densification initiative that added seats to narrow-body cabins by reducing legroom and removing seat-back entertainment screens. The idea was to lower cost per available seat mile by cramming more passengers onto each flight. The financial logic made sense on a spreadsheet. In reality, it destroyed American's premium brand perception. Frequent flyers began comparing the experience to Spirit or Frontier. The operational side hasn't been much better. In 2025, American Airlines ranked just 6th in terms of on-time arrivals in North America. American has committed to expanding its wide-body fleet to around 150 by the end of the decade, including 19 new Boeing 787-9s. But that's a 5-year timeline. Delta and United are capturing the premium revenue today. Most of us look at airline fleet decisions and see them as straightforward. Buy planes, fly routes, make money. But when you line up what Delta, United, and American have done over the past 5 years, a much deeper pattern emerges. Delta's advantage isn't any single aircraft order, it's 2 moves working together. First, extreme capital discipline on acquisition. Second, surgical investment in the premium cabin product that passengers actually touch and feel. The plane can be old, the seat has to be new. United's bet is similar. Scale, next-generation wide-body orders, massive infrastructure investment. When it works, it's unbeatable in reach and capacity. American tried to thread the needle, simplify the fleet, densify the cabins, cut costs, and compete on price. But in an era where premium revenue is driving industry profits, that strategy has left it generating a rounding error of profit compared to its peers. If you're building a business of any kind, this exact tension applies. Do you invest in fewer, higher quality assets and extract maximum yield? Do you bet on massive scale and hope the supply chain holds? Or do you cut costs and risk becoming the low-price option in a market that's moving up-market? As of 2025, the scoreboard is clear. Delta generated $5 billion in net income and $4.6 billion in free cash flow. It reduced net debt to approximately $14 billion. United brought in $3.3 billion in net income on $59 billion in revenue, profitable and growing. American posted $111 million in net income on $54.6 billion in revenue, a margin so thin it practically disappears. So what's the lesson here? Delta won by treating fleet acquisition like a value investor treats stocks. Time your purchases. United bet on scale and ambition, and it's paying off. American sacrificed premium positioning for cost efficiency and is now scrambling to reverse course in a market that rewards exactly what it gave up. In the process, these three airlines have turned a seemingly boring question, what plane should we buy, into the single most consequential strategic decision in commercial aviation. And if you want to see what happens when one of these carriers tries to rebuild from the inside out, keep an eye out for our upcoming deep dive, specifically on American Airlines fleet. That video is already in production, and trust me, there's a lot more to unpack. If you want to hear more stories just like this, be sure to subscribe to the channel. I'll catch you in the next one. Hey, before you go, the YouTube algorithm thinks you're going to like this video next, so why not check it out?